All right, it seems like I'm all set now. Thank you for your patience. We have a few people here already, so we are going to get started. Welcome to today's program. Thank you so much for joining us. In this meeting, we will review the reasons to create a balance sheet and look into a few resources that will hopefully make it easy for you to do it yourself. MSU Extension can create a balance sheet for you as well, but either way, you need to have a good understanding of the matter because you will be the one collecting the information. I really look forward to working with you on this subject and hope that the information I will present is useful to you. So I am your host for today. Let me just introduce myself. My name is Florencia Colella. I am a farm business management educator with Michigan State University Extension. I cover West Central Michigan, but if you do not live in West Central Michigan, you're welcome to contact me as well. My contact information is online. You can just search for my name. And my pronouns are she, her, hers, and I am multiracial. So before we start, I'd like to show you our civil rights slide and acknowledge that MSU occupies the ancestral, traditional, and contemporary lands of the Anishinaabe, Three Fires Confederacy of Ojibwe or Dabwa and Potawatomi peoples that was seated in the 1819 Treaty of Saginaw. A couple other housekeeping issues. We will be recording this session and we will post it online with optional English and Spanish subtitles afterwards. You can also take a moment now to turn on or off live automatic closed captions, which you may be seeing on your screen. There were instructions on how to do this in the pre-webinar email you received this weekend. You may also enter any questions or comments in the chat box that's open for you all to type in. And I will try to address them all during our meeting today. I hope this is an open conversation. So you can also, I think, unmute yourself. And if you cannot unmute yourself, let me know in the chat box and I will unmute you. If for any reason we run out of time, I will email you afterwards any answers to questions that I either may not know or may not have had time to address. You will, like I said, get a follow-up email, and in that email there will also be a link to an evaluation survey, which I hope you can take 2 minutes. It just has one question, actually. It's a long one question, but it's one question. So I really would appreciate it if you could send your feedback that way. And you're also welcome to share your video, but you don't have to. And in that vein, I wanted to recognize that we are still living in a pandemic. So my office setup or your office setup may be less than optimal in terms of background noise, interruptions, or poor internet connection. So please, let's give each other as much grace as we can. And let me know if anything is not working for you on your end. So let's move on to our show. Today, we are going to review these two tools. So if you happen to be on a computer, I would invite you to copy these or just try to type this into your browser, because these are the two tools that we're going to be reviewing today. So like I said, you can just put this on your browser and I'll show you how in a minute. Try to have that handy. So let's just show you. If you just type those into your browser address bar, this is the Farm Records book. It's one of the tools that we will be reviewing today. So you can access this. It's free of charge. It's going to be a view-only version, so you will not be able to make any edits to that yet. And you will be able to either print it at home if you prefer to just work on paper, or you would be able to download it to Microsoft Excel. Or if you are a Google fan instead of a Microsoft fan, you can just make a copy and use it right into Google Sheets. There's videos online where Whoops, my phone is talking to me. I'm sorry. There's a couple of videos online that I made where I explain in more detail how to do this. And I'm happy to send you the links to those if you need a little more time to figure out how to do this. Or just put it in the chat and I will explain. So just 1 second. Here I show you what the farm records book is. So this is basically just a set of tables where you can enter your transactions by date in different categories. It's organized the same way income taxes are. So a benefit is that it makes tax filing easy, whether you're doing it yourself or you're using a tax preparer. And on the other hand, this tool, the Farm Records Book, is designed to be simple. So it does not have formulas there. So if you don't know how to do formulas and you're scared about that, you don't need to worry because you're not going to screw this up. You will be able to edit anything if you just make a copy, either in Excel, in Google Sheets, or on paper. And then if you screw up, you can always go back to the main version that's on those links that I just showed you. So it will be up to you, though, to add up things right. Or if you do like formulas, just enter them yourself in the spreadsheet, and I'm happy to help you with that. So the great thing about the Farm Records Book is that it walks you through the collection of accounting records, balance sheet records, production records, and so forth. This meeting is about balance sheets, so we're going to focus on that, but I just wanted to show you this. The Farm Records Book is also available on paper, so you can buy it online from the MSU Extension bookstore. It's $15, but by the time you add shipping, it turns out to be like 20 something, which it's up to you whether you want to just print it at home or buy the paper version. And we're working on translating this into Spanish if any of you are Spanish speakers. And so here's a picture of the booklet that you could buy. But like I said, you can also print it online. And I also wanted to show you here, this is my picture, and these are my colleagues around the state. MSU Extension can put together the balance sheet for you. But like I said before, you are going to have to collect the information anyways, and that's what we're going to work on today. Okay, so let me switch. I'm going to stop sharing this, and I'm going to show you here. I have the two files that I was just telling you about. This is the Farm Records Book for Management. It has a lot of different tabs to enter a lot of different, your accounting records throughout the year. But today we're going to focus on this sheet number 8, which is the balance sheet. Here's where we're going to start. And I also wanted to show you this other file. I will scroll up. This other file, which is, if I can just go back here, is the one that you access by going to this link. It's just the balance sheet. It's the same thing, but it is just the balance sheet part if you're not interested in the accounting records part, okay? All right. So as you may be seeing on your screen, let me make this larger. And please let me know if anything is not looking right on your end. But so there's a long explanation at the top, which I'm going to walk you through. And here's the last part of the explanation, which I guess I can share with you. Creating a balance sheet is a lot of work. So don't get discouraged with the amount of information. Just fill it as good as you can. And once you've done it once, it gets easier year after year, which also can be a bad thing because once you are, used to a certain way of doing things, sometimes it can be hard to change, and sometimes change is good. So anyway, I'm here to help you throughout this whole journey. All right, so let's jump into the net worth statement. So the balance sheet or net worth statement is a snapshot of the financial position of the farm business at a given point in time. Can you turn on your PowerPoint presentation, Wine? You're asking me. Yeah, but this is actually what I want to show you because we're going to be working on this spreadsheet. My PowerPoint presentation is right here. I'm happy to show you anything. It is hard and too hard to see. Okay, let me see if I can move some stuff around my screen. Too small. I see what you're saying. That made it just a little bit larger, and let me see if I can do that. That is pretty large, I believe. Let me see if I can make this even larger. Well, that's a little too large. That is like taking up my whole screen space. Do you see the spreadsheet on the whole screen? Hopefully you do. Anybody else that finds this too small? It only takes up about 1/3 of your screen. And what's on the rest of your screen? You probably want to double click at the top of your Zoom if you're on a computer, so that you can see Zoom in a large screen or in the whole screen. Anybody else that wants to tell me? Okay. All right. Glad to know you are seeing it now. So the balance sheet or net worth statement is a snapshot of the financial position of the farm business at a given point in time. Everything the business owns and owes is listed on the balance sheet. The balance sheet provides a summary of how funds have been invested in the business, which are your assets, and the financing methods or liabilities used at a given point in time. Accurate and detailed balance sheets are needed to accomplish the following: analyze the financial performance of your business, secure credit and financing from lenders or grantors, monitor financial progress over time, make financial projections, understand your risk position, provide information for transition planning, and so forth. So I actually have a poll here for you all. So you should be seeing a poll on your screen now that asks you, why are you interested in creating a balance sheet? If you have 1 minute and you're not driving or doing something like that, could you please answer to that? Just gives me an idea of why you're here. Thank you to those that have already answered. Anybody else that wants to give me the answer? All right, we're going to stop the poll. All right, thank you, everyone. Okay, so most of you want to have your papers in order and want to understand your business. Great. And actually, here there's another poll. That would help me understand, who are you? Are you all producers here in the meeting today? Okay, I'm starting to see your answers come in. Thank you. All right. Thanks everyone for answering. And we have mostly producers. We also have an educator, a couple students. Oh, actually, I didn't share my results. So, all right, now you should be seeing your answers. Okay, let's keep going with the balance sheet. So the first step in building an accurate balance sheet is to select the date that the balance sheet represents. Because like we said, the balance sheet is a snapshot. So this needs to be consistent from year to year so that you can compare. And December 31st is the preferred date, as this corresponds to the end of the previous cash accounting year and the beginning of the next. Having accurate balance sheets for the beginning and end of the cash accounting period enables adjustment of cash accounting for inventory changes. So this may start getting confusing to you. Let me see if I can explain. What I just said is having accurate balance sheets for the beginning and end of the cash accounting period enables adjustment of cash accounting for inventory changes. What this means is the following. If during the year you have collected your income and expenses, you will have a good idea of your profit, except that your profit will not be the same if you spent a lot of money on growing crops and now those crops are stored versus a year where you didn't spend money in growing crops and you're done farming, or for whatever reason, you do not have those crops stored. Which year did you make a higher profit? You spent a lot of money, but you grew crops. Or was it better to spend less money, grow less crops, but you had maybe storage from the previous year? I guess I'm not sure if that's very clear, but what I'm trying to say is inventories matter. So we need to take those into account when we're calculating your profit. It's not just how much I made minus how much I spent. That's my profit. So that's why that's one of the reasons we want to create a balance sheet. All right. The next step is to decide what business entity the balance sheet represents. Sometimes there will be a partnership, there will be an individual, and the farm may be composed of many different business entities. So it's important to decide what entity we are trying to represent. We can create different balance sheets for different entities, then create like a bundled balance sheet. There's different ways of doing it. Okay, and so once you decide these things, make sure you write that down somewhere. If you're going to be using this template, make sure you write that down somewhere. Oh, and by the way, if for any reason you do not like this template, you do not like this format or whatever, there is another balance sheet that I wanted to show you. So you're hopefully seeing MSU's webpage. And John Laporte is one of my colleagues in the south west side of the state. He also has a farm balance sheet template that you can download and use if you like that better. So it's just another option. Okay. So within the balance sheet, it is important to keep farm and non-farm assets or personal assets and liabilities separate. Most farm balance sheets break both assets and liabilities up into three categories: current, intermediate, and long-term. Net worth or equity is the difference between your total assets, which is what you own, and your total liabilities, which is what you owe. Okay, so now we're going to go into each of these tables. So we said assets are all the things that you own or that are owed to you as of the date of the statement. There may be a liability. You may own something, but you may have a mortgage or a loan. So we're going to deal with liabilities later. For now, we're just going to look into assets. And so, like we said before, assets are divided into current, intermediate, and long-term. And we start by collecting our current farm assets information. Current assets are cash and other assets that you expect to receive, convert to cash, or consume in production during a business year. Remember to include cash in farm cash checking and savings accounts as of December 31st. And that's what we are going to be doing in this first table. All right. On the second table, we are going to enter prepaid expenses and supplies, which should include items such as fertilizer, lime applied, seed, feed, and other inputs purchased for next year's production. All supplies on hand should be priced at their cost, at how much you paid for them. Okay, so that's what this table is. Third table is cash in growing crops. Growing crops include seed, fertilizer, fuel, and other expenses already invested in crops. They should be listed as at the actual cash costs invested to date. And at the bottom of this table, which I'm not going to scroll down all the way because it's long, but I mean at the bottom of this page, there are hints for making estimations. If you are not sure how many tons are in a bushel or how many tons may be in a silo or those types of things, there's hints for all of these things at the bottom. Okay, so growing crops, we saw that already. Let's look at accounts receivable. Accounts receivable includes any amounts owed to the business and expected to be collected within a year. Government payments should reflect payments yet to come as a result of past activities, not future activities. Hopefully that makes sense. Inventory. Okay, so there's also a table for hedging accounts, which very, very few people use, and other current assets. Crop inventory these are crops for sale or feed, and it should include all crops in farm or commercial storage by December 31st. You would be listing the crop name, the quantity, and the total value for each crop. The value should reflect the current market price unless it is contracted at a different price. In the description column, note whether it is standing or stored and used for feed or for sale. Crops under government loans are crops that secure a government CCC loan. If you have one, include the total market value of CCC loan crops. A crop under loan can be valued and listed with crops held for sale only if you're going to offset that later by a loan against it in the liability section, like we said before. All right. Livestock for sale should include all market livestock being held for the sole purpose of eventual sale. Do not include in this table breeding livestock, those to be culled from the breeding herd or breeding herd replacements. Those go in the next table on intermediate assets. But list the livestock type, the number of head, and the value of each livestock type. The value should reflect the market value of the livestock on December 31st. And if you have trouble calculating that, let me know and we can think together how to do it. It can be challenging sometimes. Okay, actually, yeah, here we are adding your total current farm assets. Okay, there's a space just to add all of that. And then you go on to intermediate farm assets. Intermediate farm assets are those resources intended to support production rather than go for immediate sale. Such assets are expected to have a useful life of 1 to 10 years. Breeding livestock are livestock held for the purpose of producing offspring or livestock products, such as milk. List here the total value of the herd, herd replacements, and herd size, if you are a dairy. If not, just leave it empty. Keep going. Any questions so far? All right. Just type them on the chat if you have them. So machinery and equipment and titled vehicles should be listed on the blank space provided here with all of the information as best as you can. And remember to include marketable value and undepreciated value. So cost value and market value, which I don't think I have explained much yet about the difference between cost value and market value, but I will. So let's just keep going for now. Oh, and here, it just gives you space to do some math. So last year's inventory, add up everything you had before this year. Just write your result here and here. This year's purchases, again, here and here, you write down how much you spent on machinery and equipment. This year's sales, how much you spent on, how much you made on resale of machinery and equipment, and you enter that here and here, which gives you this year's inventory, 1 plus 2 minus 3, and you enter that here. Then you can calculate depreciation. And there's different ways to calculate depreciation, but for our purposes, we usually use economic depreciation, which is a 7% of the total inventory. So we just calculate 7% of these numbers, enter that here, and then subtract this number from this number and enter the result here. So that's going to be this year's depreciated inventory, and we are calculating that for our cost value only. Right, hopefully that made some sense, and we're going to go into what cost value is in a minute. Okay, let's keep going for now. There's also a space for titled vehicles, same thing. Other intermediate assets. And these include buildings with a short life and securities not readily marketable. And that's the end of intermediate assets. And you have a space here to add up your totals for cost value and market value. And then we move on to long-term farm assets. Long-term assets include items of a more permanent nature, such as farmland, buildings and improvements, and co-op shares. Farmland should be listed showing the acreage and value of each parcel of land owned. And buildings and improvements, which are on the next table, should be listed and valued on this table. And again, these suffer from depreciation. So there's this bottom table to do the same math here, as I explained before. Other long-term assets include co-op shares valued as of the date of the statement. And that brings us to, okay, there's a space to add up long-term farm assets, and then to add up the total farm assets, which are line 1, current farm assets, line 2, intermediate farm assets, and line 3, long-term farm assets. Okay, and we do that for both cost value and market value. That gives us our total farm assets. Okay, and then we also have to look into non-farm assets or personal assets. Non-farm assets are those assets not used in the farm business. These could be profits taken from the business for personal use, and consider also the value of non-farm businesses, non-farm property, personal residence, household items, retirement funds, cash value of life insurance, and so forth. Okay, and so here there is a table for personal assets. And for personal vehicles, same structure that we saw before. And for cash value of life insurance, like I just said. And it gives you a space to add up your non-farm assets and then do the math for combining your total assets, farm, non-farm, current, intermediate, long-term, everything together, okay? Before we go on to farm liabilities, I'm going to go a little deeper into cost value and market value. What is all of that about? So the market value and cost values are the same for current assets. So let me scroll up just a minute. So you can see here, we are always asking you for cost value, market value, but for current farm assets, there's just one cell. The market value and cost values are the same for current assets. So there's just one number, and when you have to add that to other numbers around here, you will use that number plus cost value, and that same number for current assets, which is line 1, plus market value. And this is where we were. Okay. Values for intermediate and long-term assets should be determined using both the cost value and the market value. The cost value is the purchase price minus any depreciation taken to date, which you do by just following all of these instructions. This should ideally be consistent with income tax records, but it may not be consistent with income tax records. And in that case, then you can just pick whether to follow your income tax depreciation or calculate an economic depreciation, which is what we're doing here. Hopefully that makes sense. But some sort of depreciation you need to take into consideration for the cost value, okay? For market value, we don't do depreciation. Okay, so the cost value, since you are taking depreciation, is then the remaining undepreciated tax basis, what you paid for it minus any tax depreciation claimed. It's what remains, which is called the undepreciated tax basis. Okay, on the other hand, the market value is the amount that would be received if the asset were sold on the open market. It is important to use consistent values from year to year. And so, for example, if one of these is easier to one of you, maybe you are used to using cost value, maybe you're used to using market value, maybe you just don't want to deal with two numbers, which I understand. Then why using two numbers? We use both values, or we ask for both values so that you can make the most out of your analysis. There is space to enter both the cost value and the market value in the worksheet. And the reason is that lenders want to see the market value of term assets so that they can determine your ability to repay if the loan had to be foreclosed. Accrual income statements over several years should be used to determine your ability to repay without foreclosure. So they are going to analyze that, but they are going to ask for your market values. Farm investment planning is another application of asset market value valuation. For example, should I spend my money on this piece of machinery or on some off-farm investment? Well, to answer that question, market values are a good way to compare different types of investments. However, for existing business analysis, if you have a farm already, you're not thinking of investing your money elsewhere, and you want to see how your business is progressing, then using a cost basis makes more sense. Market value only can be very misleading in determining profitability and monitoring financial progress over time. So the cost value, and that's because the cost value balance sheet is not affected by inflation or deflation and is more useful in monitoring the business financial profitability and progress, since only the changes in net worth resulting from earnings are included. So a positive cost value farm net worth indicates that the business has had greater profits and or contributed capital than what it has pulled out of the business. A business with negative cost value net worth indicates that the business has had losses and or has pulled more money out of the business than profits generated. The difference between cost value net worth and market value net worth is called market valuation equity. We'll see that later. And this equity is commonly from inflation and from machinery being valued greater than the remaining tax cost basis. So having cost and market valuation balance sheets allows the manager to see where equity is coming from retained profits, from money you made, or from inflation, basically. There's another term, the term retained earnings. Retained earnings are basically equal to the cost value net worth, and we'll see that in a little more detail later. Okay, we are ready to go look into liabilities. If I have hopefully convinced you that keeping cost values and market values is a good idea. Let me just drink a little bit of water. All right. Okay, so liabilities are all obligations that are owed as of the statement date. Do not change the classification of a liability as it matures. If you started it as a current liability and then for some reason you've refinanced or something, try to keep it under current anyways. Cost values and market values are the same for liabilities. So if that was hard for you on the asset section, now you don't need to worry about that anymore. That's only a thing for intermediate and long-term assets. Okay. Current farm liabilities. Like we said before, liabilities are also split into current, intermediate, and long-term. And current farm liabilities are those due and payable on demand or within the operating year. These include commodity credit and operating loans, accounts payable, and accrued expenses. Accounts payable and other accrued expenses should be listed with the name of the account holder and the amount owed. Include such items as unpaid bills, seed, fertilizer, feed and fuel accounts, past due taxes, rents, and judgments. It is important to separate and understand the difference between borrowed money and unpaid bills. In cash accounting, unpaid bills have not yet been claimed as a tax-deductible expense, so they would go here. Whereas borrowed money would go here, and that means that they have been claimed as a tax-deductible expense. Hopefully that makes sense. Current loans include the current balance on operating loans, feeder livestock loans, credit cards, and other loans that are due within 12 months. There's a space for interest rate, where you would enter the interest rate on the note, principal balance, which is the total outstanding principal balance. And please do not include accrued interest in this column. This would just be the principal. There's space for accrued interest on this column. And it's the amount of interest that has accrued since you made your last payment. Your lender can probably give you this information if you don't have it, and we can also help you calculate it if you need us to. Okay, principal and interest payment is the total amount of principal and interest to be paid within the next year. For most current debts, you can simply enter the word all. So anyway, just complete this as good as you can with as much information as you can. If it's a number, it's a number. If it's a comment, it's a comment, and we can help you put it together if you need us to. And month due is the month the payment for the current year is due. And again, that can be multiple payments. So you can write something like multiple, monthly, bi-monthly, something like that. If a CCC loan is entered in this table, make sure the product is listed on the asset side of the balance sheet as well, like we said before. Okay. Oh, and here there's a space just to add unpaid accrued interest. And these two, we're going to come back to them later. But basically what we're going to do on these two lines is add to the current loans accrued interest the current portion of your intermediate loans or long-term loans, so that we can have basically what interest we're going to be paying this year. So intermediate loans, like we said, well, we haven't seen intermediate loans yet, but as you can imagine, they are loans that you took for machinery, vehicles, that type of thing. You're going to be paying interest on those loans for more than 1 year. But the first year, or the current, not the first year, the current year is a current liability. The interest, the current year interest is a current liability. So we want to have that on this table. Same thing with long-term loans. You may have a mortgage. Well, your mortgage interest that you're going to be paying next year is a current liability. What will happen on years, after that, then goes on your long-term liabilities section. Hopefully that makes some sense. So let's keep going, see if it clarifies. Here, there's a space to just add all of the accounts payable from this table and other accrued expenses values from 2 tables prior. So these 2 tables, plus all principal balances for current loans from last table, plus lines 7, 8, and 9. All right. And there's a space here to enter the total. Let me know if anything is like too confusing, either now or when you go ahead and start trying to put your numbers in here. Okay, intermediate farm liabilities. Intermediate liabilities, like we said, are debts against intermediate assets, machinery, breeding livestock, and perhaps buildings. Depends. These typically are due within 7 to 10 years. For intermediate loans, follow the same instructions that we said before for current loans, except that final year is the year the loan is scheduled to be paid in full. We didn't have that in the other table. Principal due is the total principal due within 12 months. And it is the principal portion of the annual principal and interest payment. Okay, so principal balance is the total balance. Principal due is the principal due next year. Once you have all of this information, then we are able to calculate something that's important, which is your intermediate balance, which can be calculated as principal balance. So all of the money that you owe on that loan minus principal due, minus the principal that you are scheduled to pay next year. So that would be your intermediate portion of the loan. Okay. Loans for machinery and equipment purchases and breeding livestock will fall in this category, like we said. Leases, such as on silos and machinery, should be added here as well. And that would be all for that table. There's a space again to add up the total with an explanation there. And then we go on to long-term farm liabilities. Long-term liabilities are against long-term assets. This will usually include loans, land contracts, mortgages for the purchase of long-term assets, such as land, buildings, and other permanent land improvements. These typically were set up originally with 10 or more years to repay. For long-term farm liabilities, follow the same instructions as before. And again, we are going to calculate your long-term balance as the principal balance, which is the whole principal that you owe, minus the principal due, which is the portion of that principal balance that you're going to be paying next year. Hopefully that made some sense. And you're able to add up your total long-term liabilities, and so that you're able to add up your total farm liabilities with current, intermediate, and long-term liabilities included, and then move on to non-farm liabilities. Non-farm liabilities are those liabilities against non-farm assets. They include non-farm accrued interest, accounts payable, non-farm loans. Also remember to include credit card balances, taxes payable, car loans, school loans, non-farm business debts, house mortgage, etc. Okay, and so here's personal liabilities, personal loans, total, and deferred liabilities. So deferred farm liabilities are taxes and other expenses to be paid when assets are sold. Deferred taxes arise because of the difference in the balance sheet value of assets and their tax basis. So in other words, if the business is liquidated, what would be the taxes on current inventories and capital gains taxes be? This section is optional. But if you are considering a change in the business that involves liquidating, then it's useful, and we would invite you to fill that up. But if not, don't worry too much about it. All right, next section is equity. Equity is used to document capital contributed from or stock issued to sources outside the operation. Equity is most commonly used by entities such as corporations and LLCs. An example of contributed capital would be if a newly incorporated farm has 5 initial investors who each contributed $1,000. By using detail under the contributed capital entry, each of the contributions can be itemized and the original source of that money documented. Same thing, you don't need to be on a partnership or on an incorporated or LLC farm. If you invested money on your farm from your off-farm job, for example, you want to put that there. All right, so that is the end of the information that you are collecting, okay? From there, we can do 2 things. You could contact your farm business management extension educator, and we could put together your balance sheet. And I wanted to show you a couple examples of, hold on, of what a balance sheet that we created for you might look like. Okay. So this is what it looks like, and it has the same sections that we reviewed before. Current assets, All of these things I discussed earlier: intermediate assets, long-term assets, total assets, personal assets, everything we discussed before on the asset side to the left. And on the right side, current liabilities, accrued interest, current loans, intermediate liabilities, long-term liabilities, total liabilities, okay? So you can either do this yourself following the template, or we can put together something like this. If you think it looks nicer, we are happy to do that. Okay, but at the bottom here, you see how you come up with total assets, total liabilities, contributed capital. We discussed this. So I want to talk to you a little more about how to calculate these last three pieces of information that are important, that are basically like your total net worth, the things that are going to allow your lender or whoever to analyze your business. So let me go back. I'll make this larger. Okay, so like I said, basically we can do that math for you, but it's really very simple and you could do it yourself. The first thing you would have to do is calculate farm net worth, which is line 4 cost value minus line 19. Can you guess what this is? Farm net worth? It's assets minus liabilities. Let's go back and double check. Line 4, total farm assets minus line 19, total farm liabilities. That's what net worth is, okay? So there you have your farm net worth, and you do that for both cost value and market value. Then you can calculate your retained earnings, which are line 4 assets, cost value. So your cost value assets minus line 19, which are your total liabilities, minus total contributed capital from the last table that we discussed. Maybe you have none, maybe you have some. If you do, you subtract that as well. Okay, and this is just one number, you put that there. Then you have the farm market valuation equity, which is line 4, total assets, but market value minus line 4, total assets, cost value. So you subtract your cost value assets minus your market value assets. That gives you farm market valuation equity, and you put that here. Then we move on to non-farm net worth. And we look at your line 5, which are, guess, your non-farm assets, minus line 20, which, what is that? Non-farm liabilities. Let's make sure I'm not lying to you. So line 5 minus line 20, there was line 20, total non-farm liabilities, and line 5, total non-farm assets, okay? So that tells you your non-farm net worth. And you can do cost value and market value for that if you want. Okay, and then you combine farm and non-farm net worth, subtracting line 21 from line 6, subtracting your total combined farm and non-farm liabilities minus line 6. What was that? Total combined farm and non-farm assets. So assets minus liabilities, again, is net worth. And we put that here for cost and market value. And then another thing you can look at is the change in combined net worth, which is this year's minus last year's total combined farm net worth for both cost value and market value. And so that way you can compare if your farm or your business was worth more this year than last year or the other way around. That's actually the end of this table or this sheet. Here at the bottom, like I said before, there are hints for making estimations. So I'm not going to go into that because you may not need those hints, but if you do need them, you can go and get them from there. All right, so being 10:58, are there any questions? All right, if you have any questions, you can type them in the chat box. If you don't have any questions right now, if you're overwhelmed, I understand. Just see if you can do this at home and let me know if you need help, okay? I'm happy to help. So I wanted to show you just one last slide. Hopefully you can see that in whole screen now, and I showed you all of this already. But I also wanted to make a plug for the Farm program. So we talked about balance sheets. The Farm program is more about record keeping. And I just wanted to let you know that if, I don't know how you're keeping your accounting records in your farm, but the Farm program costs about $550 per year. And you get all of these things that are listed here. The most important of which being, in my opinion, the fact that they review and back up your record keeping work. Record keeping is tough. And so this is meant to help you with that task. There's also tax benefits and a lot of education, and they work with QuickBooks and PCMARS. So, which is another record keeping system designed specifically for firms. So if you're interested in record keeping software, this is not a software because the software is QuickBooks or PCMARS, but it's a system, okay? All right. That being said, I hope this information was useful to you, and I look forward to seeing you at the next webinar. Thank you so much for coming. Stay in touch. Let me know if I can help, and we'll see you on the next one. Bye. Hi, Danielle. You're welcome, Kathleen. All right, I'll send you the follow-up email and we'll stay in touch. Bye.